Good afternoon. On behalf of Infomerics Ratings, it's my privilege to welcome you all to this information dissemination analysis of contemporary issues once again. As some of you would be aware, we have started this series about 2 months back, and it's gratifying to find that this kind of an exercise, sharing our views in a video format with a large number of our viewers, has evoked an excellent response. Carrying forward this series, today we have a discussion on an issue of considerable contemporary significance, the issue of post-Covid-19 banking system in India. Before we come to the banking system, let me try to give some kind of a perspective, some kind of a broad framework, placing this issue in a proper historical, international and national perspective. This is important because things cannot be considered in isolation, in some kind of a silo, because increasingly it has been realized that there are interdependencies and interlinkages across various segments of the financial system, across different countries, and the world has increasingly become what we have in India always called, for thousands of years possibly, Vasudhaiva Kutumbakam, the world is a community. So this concept of Vasudhaiva Kutumbakam has been increasingly brought to the fore by the ravages, by the devastation caused by Covid-19. Covid-19 has sometimes been compared to the financial meltdown of October 2008 and even the Great Depression of 1929. But there have been a large number of assessments by multilateral institutions like the International Monetary Fund, IMF, International Bank for Reconstruction and Development, the World Bank, Asian Development Banks, Niti Aayog, the Reserve Bank of India, rating agencies, and a variety of other institutions and individuals. All of them are agreed, despite significant differences in nuances, in subtlety, that this is perhaps like a time no other in history of the last 100 years. I do not wish to do any data crunching, but let me highlight one important report which was placed in the public domain by the World Bank on June 8, 2020. This report highlighted that the global economy will shrink by 5.2% this year. It has to be realized that this would be the deepest recession since the World War, with the largest fraction of economies experiencing declines in per capita output since 1870. Obviously, this is a deeply sobering outlook, with the crisis likely to leave long-lasting scars and pose major global challenges. If we look at the situation in India, the first quarter was terribly bad, where the GDP contraction was something of the order of 24%, 23.9% to be exact, but hopefully things will look up now. But it is a matter of some concern that India's animal spirits remain fragile despite the process of unlocking which is currently on at the national level. I am reminded of the well-known maxim of res ipsa loquitur, facts speak for themselves, and this maxim clearly brings out that things are not hunky-dory whether you look at the assessment of the Government of India or the Reserve Bank of India or other institutions, individuals working in this area, there seems to be a fair measure of consensus that this year we are likely to see a contraction something of the order of 5 to even 10%. Now this kind of a perspective is important because the banking sector cannot be considered in isolation, in some kind of a silo, because the banking sector, it's our submission, is a microcosm, is a miniature model of the broader national economy. Hence, the case for repositioning banks in this kind of a weak macroeconomic scenario has to be placed in a proper historical and comparative perspective to draw the right kind of lessons in this constantly evolving world, a world in which perhaps change is the only constant. When we look at the position of public sector banks in India today, we find that there are large number of problems, there are large number of issues of considerable concern to the public sector. There is obviously the issue of modest capital buffers for public sector banks. This is again a complex issue. Sometimes it is also linked to the Basel II norms, and it is felt that in this kind of an environment there is no need for Indian capital adequacy norms to be pegged higher than the international benchmarks. Be that as it may, there is no doubt that capital adequacy of Indian banks, particularly the public sector banks in India, needs to be shored up, needs to be strengthened significantly. There are also issues of mounting NPAs in the Indian banking sector. Recently, the Reserve Bank of India placed in public domain its biannual FSR, Financial Stability Report, and this Financial Stability Report has worked out different kind of scenarios, and some scenarios paint a really scary picture of the NPAs, which could go up to something like 14%, 14.5% shortly. There are also the issues of higher credit costs, weaker earnings because of interest reversals, and low fee income, together with subdued growth prospects. But in all this discussion, we must not lose sight of a basic issue. Sometimes we have a tendency to look at things in a simplistic framework, but then it has to be realized that the banking industry, what is technically known in the language of the Reserve Bank as SCBs, Scheduled Commercial Banks, that means those banks which are listed in the second schedule of the RBI Act 1934. Now this SCB, sometimes also referred to as the banking industry, it is not a monolithic category. There are significant differences across public sector and private sector banks, and even within these two groups. But on the whole, perhaps it would be fair to say that private sector banks are today better positioned to withstand post-pandemic challenges. The Reserve Bank of India has been proactive in taking various steps to reduce the pain and suffering of the common man. Towards this end, it has reduced the repo rate by 115 basis points since March 2020 and reverse repo by 155 basis points. It is a matter of some concern, however, that the banking system liquidity continues to be in surplus. There are some estimates which place the liquid in the banking system in terms of the amount parked in the reverse repo window with the Reserve Bank of India to be in the region of 6 to 7 lakh crore, depending on the timeline you look at. Hence, liquidity continues to be in surplus mode despite several measures taken by the regulator, Central Monetary and Banking Authority of the country, to facilitate greater credit offtake. Low demand and increased banks' risk aversion has kept credit growth quite low, 5.5% in August 20 vis-a-vis 12% last year. The CD ratio stood at 72.5% in August 20 as against 76.4% as at end March 2020. Now let us look at various disruptions on the Indian banking system. What we propose to do here is to give some kind of a big picture, some kind of a macro framework, and here we look at the disruptive changes on the Indian banking system from 2 points of view, short term and medium term. In the short term, there have been issues of difficulty in accessing branches for routine operations, default in loan payments by both individual and retail customers, is scaling down of non-essential banking operations. There has also been a significant reduction in domestic and cross-border trade, reducing forex transactions. There has also been an inability to access data and infrastructure. All this has led to reduced serviceability. Now let me come to the disruptive changes in the medium to long-term framework. I am aware of the fact that any discussion of long-term is fraught with difficulties, and I am reminded of the famous comment of Lord James Keynes when he said about almost 100 years ago that in the long term we are all dead. But then, in an issue of considerable significance like the banking system, sometimes it's advisable to step back and also place things in a relatively longer frame of reference. If we look at things in a medium-term perspective, we feel that there is a rising need and preference for digital transactions. Increased loan defaults, mostly by MSMEs and corporate customers due to reduced revenue and margins, resulting in mounting NPLs. In this kind of a scenario, quite expectedly, there has been a flight to safety with preference for big banks and asset-backed instruments, for example, gold. There have also been a large number of layoffs, particularly in the private sector banks, due to decreased margins. With this kind of a macro picture, we must also look at things in some kind of a disaggregated manner. We also must have look at things in a more granular examination, because whether it is the macroeconomy or the banking sector or any other sphere of life and activity, perhaps the devil lies in the detail. And if you do this kind of a granular examination of the banking data, we find that incremental credit to micro and small units fell 7.6% in April and May compared to a 2.7% drop in the corresponding period last year. Similarly, credit to medium-sized industries fell sharply by 5.4% as against a modest fall of 0.9% in the similar period last year. Disbursements to large enterprises in the first 2 months of this financial year fell 0.4% compared to a steeper fall of 2.5% last year. On a larger scale, incremental credit to all industries fell 1.5% between March and May this year, compared with a drop of 2.5% last year. Incremental credit to engineering firms fell 1.3%, credit to construction firms fell 3.7%, disbursements to food processing companies fell 3.1%, vis-a-vis a steeper fall of 3.4% last year, and most strikingly, incremental bank credit to infrastructural projects grew 0.1% between March and May this year compared to a 1.3% fall last year. Now let me come to some crucial aspects of functions and working of the banking system. Most of us are aware that in the last 2 decades or so, retail banking and microcredit have been the major drivers of income, output and employment. So when we look at the retail portfolio, we find that outstanding credit card loans fell 14.1% between March and May 2020 compared with an increase of 6.1% in the corresponding period last year. Consumer durable loans fell 6.4% compared with a 3.4% decline. Outstanding personal loans fell 3.6% as against a 2.8% increase last year. Housing loans also declined by 0.7% as compared with a rise of 1.4% last year. Lending towards microcredit fell quite steeply by 9% compared with a 14.6% increase in the same period last year. Now, if we look at lending to major industries, we find that outstanding loans to chemical industries fell over 10%, loans to tea producers fell 18%, credit to fertilizer companies fell 30%, and telecom firms experienced a 4% contraction in incremental bank credit as against an increase of 7.15% last year. Bank credit to jute textile manufacturers fell 7.4% as compared with increase of 1.5% last year, and loans to glass manufacturers fell by 7% as compared with a marginal drop of 0.24% last year. Now let us look at some of the broader issues in credit management. It is gratifying to find that there has been a realization at all levels of the Government of India and the Reserve Bank of India about the gravity, the enormity of the issue, and they have been proactive in taking a variety of measures. The Government of India and the Reserve Bank of India have acted in some kind of a synchronized manner to alleviate the pain and the misery faced by the common man. But despite the government's stimulus packages and the RBI's attempts at liquidity infusion to reduce the counterparty risk or credit risk of loan transactions and thereby minimize the potential systemic risk of a banking crisis, it's almost certain that there would be increased loan defaults and delinquencies across the board. The RBI has announced some very welcome measures, moratorium facility for all term loans. Apart from this, the banks have also proactively restructured loans to reduce the cash flow burden in the near term. But given the gravity of the crisis, more efforts are required because of widespread pain and sufferings. In this kind of a macroeconomic setting, banks should prepare for losses and build capacity to deal with increase in delinquency. During the unlocking process, it is important for banks to repurpose their go-to-market and customer acquisition model, keeping in mind the changing consumer behavior. Now let me come to the issue of revenue compression in Indian banks. As most of us are aware, banks have been going through difficult times in the last 2-3 years with a drastic squeeze on their profits and profitability. In this kind of a disconcerting scenario, post Covid-19, revenue from retail and commercial banking is falling sharply as underlying consumption and transactions have seen a very sharp dip. While central banks across the world have slashed interest rates, banks are reducing yields to generate business, thus significantly reducing their net interest margins, popularly known as NIM. Income from payments and other fee-based services has also been hit by a discernible macroeconomic slowdown. We must understand the gravity of the macroeconomic slowdown because this is likely to be the first contraction in GDP in the last 41 years. And if we have a contraction of this magnitude, obviously the banking sector will not be left unaffected. There have also been measures like the moratorium, but these measures have reduced banks' cash flow. In this kind of a scenario, banks cannot do much to stem the overall drop in revenue, but they need to focus on making payments safer by increasing limits on digital payments channels and educating customers on the need for using digital products. Banks need to engage with RBI to contribute towards required policy changes in a coordinated and concerted manner. They would also do well to look at their network and optimize their network in terms of branches, ATMs in operation, and redeploy the staff based on the government's mandate and footfall. Issue of liquidity has also emerged as an important concern, and this requires optimum liquidity and credit deployment given changing rates and bond yields. It is important for banks to assess vulnerabilities, identify strategic risks based on exposure to each sector or geography before providing loans. Now let me come to the final part of my presentation. Where do we go from here? By all benchmarks, COVID-19 will have enduring impact across industries, including banks. Banks therefore need to be adequately secured with their assets, qualitatively strong and amply capitalized to meet the challenge of change and the expectations of future. Post-crisis, digital maturity and COVID-19 resiliency will determine the strategy of banking players. With three kind of distinct banking sectors emerging. First is the banks that are already future ready with truly digital banking capabilities and cost elasticity. But there is a flip side to it. As a famous Hindi dialogue goes, picture abhi baki hai mere dost. So the flip side is that this could lead to greater frauds, some kind of a misappropriations on a larger scale using the digital technology platforms. So banks need to be sensitized to make greater use of artificial intelligence, machine learning, predictive analysis, and there has also to be a greater thrust on fraud detection and risk management, know your customer mechanisms and anti-money laundering. Second, banks that are digital laggards and that need to evolve and renew due to subpar COVID-19 resilience. And the third category of banks will struggle to survive as a result of being digital laggards with subpar financial and operational resiliency. There has also to be a synchronized effort to reduce the stock of outstanding NPAs and credit premia and also improve the accessibility of banking credit. These are difficult times This is perhaps a time like no other in this century, but the tunnel may be long, the tunnel may be difficult, but India and the Indian banking system has always displayed dynamism and resilience in the past. We are confident that will be able to overcome this difficult period also. I am reminded of an important cornerstone of Christian philosophy. All religions ultimately stress the same kind of a thing, and one of the cornerstones of the Christian philosophy, which is of relevance to us at this critical juncture, is that this too shall pass. I think this applies with particular reference to the Indian banking system. I am also reminded of very famous lines by Gyanpith Award winner, famous Hindi poet Ramdhari Singh Dinkar, whose birth anniversary is also in this month. Dinkar wrote powerfully, and I quote, "ये नखत तमाके बुझते हैं, सारा आकाश तुम्हारा है." For those of you who may not be fully familiar with the Hindi language, let me attempt to give some kind of a rough English translation. The stars of the sky are fading, the entire sky is yours. So, to conclude, banking sector is certainly in for difficult times, but we have displayed immense dynamism and resilience in the past. There is no reason to believe that this time will be any different, and will certainly overcome this difficulty by coordinated and concerted measures taken by all stakeholders with a sense of urgency. This too shall pass. Hum honge kamyab. Thank you very much. Thank you for being with us here this afternoon.